Farmers across the country are increasingly seeking financial support directly from their customers, friends and family members to fund their agricultural activities, bypassing traditional banks, SACCOs and government-backed financial schemes like the Hustler Fund. According to a latest survey by the Central Bank of Kenya, at least from November, many farmers are turning to informal credit sources, pointing to a dramatic shift in borrowing patterns. NTV's Brian George reports.
According to a Central Bank of Kenya survey, many farmers report that loans from formal institutions have become increasingly difficult to access, with long loan application processes, high collateral requirements, and interest rates that are often deemed unaffordable. Additionally, bureaucratic hurdles and lack of understanding of the agricultural sector by financial institutions are exacerbating the issue, leaving farmers with limited options for formal credit. Farmers have been shifting to different credit facilities over the year, with a majority favoring big banks and digital loans around March, but the tune changed in September when SACCOs were the popular alternative. The survey revealed that 18% of farmers in November opted for loans from buyers of their produce, such as milk and coffee. This marks a dramatic rise from 0% in September, indicating a growing reliance on customer-based credit. Borrowing from friends and family was relatively higher, as reported by 25% of sampled farmers in November 2025 compared to 6% in September 2025, while the proportion of those who reported having accessed digital loans stood at 23% compared to 13% in September 2025. The proportion that accessed bank loans was relatively lower at 30% in November compared to 53% reported in September 2025. Similarly, 30% of sampled farmers reported to have borrowed from savings and credit cooperatives, popularly known as SACCOs, in November 2025, compared to 44% in September 2025. The CBK survey drew 306 respondents from wholesale traders, retailers and farmers in select towns across the country. The data also reveals notable shift in the way Kenyan farmers are using credit for their agricultural activities. Farmers continue to borrow primarily for the purchase of farm inputs, but the proportion of those seeking credit for this purpose has dropped significantly from 94% in September to 73% in November. Additionally, the percentage of farmers using loans to cover labor costs has decreased. In September, 53% of farmers reported using credit to meet labor expenses, but by November, this had fallen to 47%. This decline suggests that farmers may just be adjusting their labor budgets or finding alternative financing solutions as economic pressures continue to mount. The survey paints a picture of shifting trends in the farmers' borrowing appetite for different products, though it has not explained the causes for the trends across different lenders. A November report by the Financial Sector Deepening FSD Kenya says that many smallholder and micro and small and medium enterprises MSMEs do not have sufficient collateral for a lender to extend credit against fixed assets including equipment and property, despite a good number of them having incomes and business cash flows that ideally demonstrate their ability to repay a loan obligation. Brian George Otieno, NTV, Nairobi.